know for your next 2025 tax return. Looking ahead, there are new retirement rules kicking in that could lead you to save thousands more for your future, but they come with a catch that high earners really need to understand. So here's the deal: just knowing about these changes isn't enough. You have to know how to play the game. So most people are going to sleepwalk right through this, okay? Completely unaware of the money that they're leaving on the table. But that's not going to be you, not today at least, because in tonight's show, we are going to break down exactly what these policy changes are, who they affect, and most importantly, what you need to do step by step to make sure that you come out ahead. This is going to be your blueprint. So you might want to grab a notepad, open the app, and side by side it with this show because the information we're about to cover could secretly boost your bottom line by hundreds, if not thousands of dollars. So let's get into it. Before we get started, just a quick important disclaimer. I'm not a financial advisor, and this is not technically considered financial advice. These shows are for educational purposes only, so you will be able to get all of the information that you need to go and do detailed research to verify the information that I give, and then you guys take that information and execute it. So these new laws and policies can get complicated, very complex, and you should always talk with a qualified financial planner or tax pro to see how all of this applies to you specifically and in your individual situations. So, my goal is to give you the knowledge that you need to ask the right questions and to make smarter decisions for your financial life. Um, I'm not selling a financial service at any point during the show, so you don't have to worry about me asking you to do anything other than joining my membership if you want to get more detailed information as to how to contact individuals and go get things started. But you know what? While I'm thinking about that, I do have a buddy that was on the show a while back. Um, let's see, where is he right now? We had no, that's Happy here. Joe Mastrano. If you want to learn anything about your taxes and you want to cover any information related to your taxes, Joe Mastrano does webinars. And actually, if you tell him that you got it from this show that he told you that I told you to go talk to him, then at the end of the day, he'll give you a discount on it. So I want to go ahead and touch base on that real quick because I feel like, hey, if you really, really want some inside scoops, I'll tell you who to talk to. So I put that information on the screen for you. You got stuff scrolling on the bottom of the screen for 16 by 9 and at the top of the screen for by 9 by 16. So you'll be able to see what you need to see and take down that information if you really want to get more stuff going to improve your status in taxation. So let's get started with the first major shift. And it's a big one because it just happened. So on December 10th, we were talking about it. The Federal Reserve or the Feds made a critical decision, and they were going to uh, cut their key interest rates yet again. And the federal funds rate that we were talking about were going to be cut by a quarter of a percent point, bringing the new target range down to 3.5 and 3.7%, somewhere in that area. So I know what you're probably thinking: the federal funds rate. What on earth does that have to do with me? The answer to the question is everything. I told y'all that that cut was going to happen. And after that cut happens, we're going to be experiencing a lot of changes. Think of the federal funds rate as a wholesale cost of money for banks. It's the rate they charge each other for overnight loans. When that cost goes down, it starts a ripple effect. The Fed's implementation notice on December 11th, which is after we covered this topic the first time, officially set interest rates paid on reserve balances at 3.65%. and adjusted overnight rates, which helps pull market rates from mortgages, credit cards, and other loans slightly lower over time. Now, this was the third time the Feds has cut rates in recent months, which signals a clear change in strategy. So, for the last couple of years, they were aggressively raising rates to fight that brutal inflation we all felt. Now, while the job market showing signs of cooling, the Feds is trying to gently press the accelerator to keep the economy moving. It's a delicate balancing act, and it immediately impacts two key parts of your financial life: the cost of your debt and what you earn on your savings. So let's talk about debt first, because this is where you'll feel the effects the fastest. The most immediate impact on any debt with a variable interest rate. That's any loan where the rate isn't fixed, and it's almost always tied to something called the prime rate. Now, the prime rate follows the Fed's rate like a shadow. So when the Feds cut, the prime rate drops, so does the interest you pay. Where does it show up? First, for a lot of people, most importantly, on their credit cards. And the huge majority of cards have a variable APR. If you're one of the millions of Americans carrying a balance, which I don't like to do, this rate being cut is a welcome sign of relief. It means the interest charges on that debt will start to fall. It won't happen overnight, but you should see the change on your statement within a month or two. So, probably February or March's statement. Because since it just happened, a lot of you guys whose bank statements have already rolled over, it will not necessarily be seen on the December January statement, but it should be seen on the January February statement or the February March statement. Because realistically speaking, most people do not have credit cards that start on the first and end on the 31st. It starts mid month whenever you activated the card and ends mid month of the next month. That's kind of how it happens. Now, a quarter point drop might not sound like much, but it's the trend that matters. So, this is the third cut in a row, slowly chipping away at the cost of carrying the debt. Next up is the home equity lines of credit or HELOCs. We talked about these last week as well. These are almost always tied directly to prime rates. And if you have a HELOC you used for a home project or to pay off debt of any kind, you'll see your monthly interest payments go down very quickly. On a $50,000 HELOC, a quarter point cut could save you over $10 a month. Again, it's not a life changing scenario on its own, but when you add it to the previous two cuts, the savings start to add up. And I know that when I talk to you guys about changes, when we start talking about 15, $20 changes, 50, $75 changes here and there, um, we don't analyze it as a huge change individually, because as people we look at like a $75 change like that's nothing. That's a burger and fries. That's, you know what I mean? But when you think about your $150,000 mortgage that you've got riding right now, and that loan shifts by 20, 30, $50 a month. If you continue to pay what you used to pay, that 20, 50, $75 a month is going towards the principal now instead of interest. And that 20, 50, $70 a month is paying down your mortgage slightly faster than it used to. which also means that the likelihood that you could pay off your house just that much sooner, 1, 2 months sooner, is an improvement. It's not a massive improvement. If you were based on our amortization show, if you were paying 25% more than what your mortgage was, you would be putting more money on the principal and having less money towards interest, or the interest would be paid, but you'd be putting more towards the principal, which would reduce the quantity of money that would get interest every month. And that would benefit you. And again, we talked about that specifically because Trump was discussing a 50-year mortgage plan, and 50-year mortgage plan is a fantastic thing to get into if you're going to take advantage of the low monthly rate. Because if you get a 50-year mortgage and you pay the bare minimum, you're giving them way more money than what you used to. But if you get the 50-year mortgage and you're overpaying what you would have been paying for a 15 or 30-year mortgage, you would have a significantly lower interest rate. You would be covering more than enough, 150% or more of the mortgage, where you're putting most of the money directly on the principal. And you would have the benefit of, when times are tough, your mortgage is lower, which means that you'd be good to go with a lesser payment when times are tough. Like, for example, if you picked up a $150,000 property, and that $150,000 property was running like a $900 a month mortgage on a 30-year, but on a 50-year, that same property might be running you closer to $500 a month for the mortgage. Well, if you were still paying $1,000 to $1,500 a month on that mortgage, even if you had the 50-year, you would be paying that mortgage off faster than what you would have been paying on a mortgage just by paying the bare minimum. Then, if you came across a situation like the government shutdown, you could have put $1,000 aside and made those two $500 a month payments in October and November, went back to paying $1,500 a month after that, and you would not have seen a hiccup in your uh your mortgage rates. Another thing that changes with this is that when you do what you have to do uh with overpaying on your mortgage, you build up a larger quantity of equity towards your property. And there's a thing called a second mortgage. And a second mortgage is how much equity is involved in your property versus the value of your property versus, what you have left to pay on your mortgage. If you're overpaying on your mortgage and something happens where you need to take out one of these home equity lines of credit or something to that effect, the available credit or available equity in your property is typically what is utilized for that particular type of line of credit. So if you're overpaying your mortgage 30%, two times more, whatever the case may be, you're building up that equity faster, which builds up a safety net that you can utilize in case you needed to repair the roof or replace a car or whatever you were trying to do with that particular line of credit. So here's where it gets a little bit more nuanced about the new changes, because if you have an adjustable rate mortgage, ARM, you're in luck because your rate is set to adjust downward based on what just happened. But for most homeowners with that fixed rate mortgage, this cut won't directly change your current loan. Your rate was locked in from whatever it was when it was first established. But, and this is a big but, it has a huge indirect impact because if you're thinking about buying a home or refinancing, this is good news. The Fed's move influences long term mortgage rates, often pushing them lower. So, this makes borrowing cheaper and can make buying a home more affordable. The same logic applies to auto loans because even though we have that rate increase for auto loans of, I do believe, upward of $10,000 to $15,000 for cars made after 2025 because of the tariffs on export parts, export or import parts, so parts that are coming from out of the country to be made in America. That extra cost is raising the price of cars by about ten to $15,000. So with that knowledge, I would try to go buy me a 2019 with like 30,000 miles on it. Instead of going to buy yourself a mono electric car, you can go and get you a Chevy Volt, which is a hybrid electric car, or something to that effect, or like a Ford Fusion or something like that. Get you a hybrid electric car, gas and electric car. You don't want to get a mono electric car as of yet, but you could. It's up to you. But the rates that you're offered when you go to buy that car is heavily influenced by the feds. So a lower Fed rate means lenders can offer more competitive auto loans. Now, my observation in the experience in life is that it makes more sense, instead of getting a car loan for the car, get a cash loan, which still is impacted by this change, and use the cash loan to go buy the car, where whatever's backing the loan, which should be investment options, has nothing to do with the car. Because, like, for example, if you had $50,000 worth of a home equity line of credit, and out of that $50,000, you went and bought yourself a $25,000 Toyota Camry, cash up front. You own the car. Um, Whatever happens to that mortgage, you own the car. I don't like leveraging my assets for my assets when it comes down to my primary standard of living and the vehicles that I drive. Because if those loans default, they take the asset. Um, the millionaire mindset is to leverage something that you can afford to lose as collateral to get you money so that you can buy something that you don't want to lose. So you want to build up your assets in stocks and bonds and Bitcoin and gold and silver and all this other stuff so that you can leverage those stock options or other investment options as collateral towards cash money that you can utilize to go and buy your house cash up front, to go and buy your car cash up front, so that you don't have to deal with fluctuations of taxation and other such. But if you don't have it like that, and you're gonna take the extra money that you saved up and put some money down, you're gonna start rocking that rock. Let's go ahead and rock that rock. So the game plan here is going to be clear. If you have a variable rate debt like credit cards or HELOCs, watch your statements to make sure the rate reduction gets passed on. This isn't a green light to spend more money. It's a chance to pay down your balance faster, since less of your payment is being eaten by interest. So once you realize that the interest rate has gone down, once you look at last statement versus this statement and you see a change in the interest amount, that's the green light to go and pay down more debt faster. Okay. Now, the flip side, the coin, and the flip side of the coin actually is looking at the other side of this, your savings. Because what's good for borrowers is often not as good for savers. Now, we were just sitting over here talking about uh, Tuesday or Wednesday of last week, we were talking about getting the CDs and offsetting the CDs for the sake of financial benefit. And I was thinking to myself, I'm like, yes, if you stack your CDs every 30 days, you have a new CD that's running for a year. Every month next year, on the same day, you're going to be getting money released based on a certain interest rate. And especially if that interest rate is locked in upon a contract signing, then you're able to get more stuff back on a regular basis. If you juggle this, what will happen is you can either Reinvest your principal and keep the interest, or reinvest your interest and keep the principal, or reinvest both um, to increase the values. In the case of an emergency that month, if the money is cleared, you can take care of a problem that's inside of the realm of that amount of money. But if you don't have any problems that month, you can reinvest the money back in. Likewise, and this came off of the dynamic of there is literally nothing in our lives that is identified as an emergency that has to be handled today. Typically, the stuff that has to happen today are things that are delayed today. I think your car getting towed is probably the only thing that requires immediate resolution. Because if they take your car today, they're going to charge you daily rates. And the longer they have it, the more you have to pay. But even in that scenario, when you think about the fact that if they're charging you 25 or $50 a day to hold your car, if you need 3 days to go get the car, you have a fixed amount of money that you're going to have to get by the third day. So you don't necessarily have to rush out there and go and get the car. You just have to get the car before they sell the car. But beyond that, there's nothing in life, no matter how uh, disastrous an emergency is, there's nothing in life that is so urgent that it can't wait till tomorrow. A friend or family member gets rushed to the hospital. There's no reason why you need to go get money today. The bill is going to come to you in the mail after the person survives. The a medical appointment after the appointment is done. Car repair after the car gets fixed. You might need money for the car tow, but you're going to charge that to your credit card. You're, there's nothing in life. Your bills are expected, and if you pay them early, then you're not due for another 6 weeks. So there's nothing that happens in life, money wise, that requires you to immediately take action on something. I stand corrected. Paying the meter so you don't get a ticket, probably it. But if you knew you were going to pay that meter before you parked your car. Again, you would have gotten the money before you parked your car there and paid the meter. So there isn't a reason that I can think of where if you're being a responsible adult that you would not already have the funds before you perform the action. And no action would be performed that would require you to unexpectedly go find money to go and take care of that situation. Typically, things like unexpected gambling debts. You know what I'm saying? Bonding yourself out of jail, DUIs, cost of court, settlements on lawsuits against you. Those are things that happens where now you got to redirect money, but it's still not. You got to do it today. It's like you got to do it within a reasonable period of time, but you don't got to do it today. So when we think about this, you have to think about how you could put your money somewhere because we're right now we're talking about saving money in banks. You could put your money away into a CD and offset them. And within the next 30 days, the one is supposed to clear up for you instead of reinvesting that one, the one that you know that's coming in, that's the expected due date. So if you have a financial obligation that needs to be covered, this would be the moment where you would tell whatever uh, collector, for whatever reason, that, good faith, I will pay you the money. I have X, Y, and Z that is supposed to go towards this, and that money will be made available after X, Y, and Z date over the next couple of weeks. And usually, the collector of the debt will wait for the money. They're not going to tell you, no, that's unacceptable. You got to give me money faster. No, it's like, bro, my money doesn't clear the bank until if your money didn't clear the bank until the 25th, you could tell in the day it doesn't clear the bank until the 25th. And the 25th is around the holidays, so you might not be able to get it from me until the 27th. But by the 28th, you and I should be able to work this out. So even today on the 22nd, going into the 23rd, I'm still telling whatever collector that, hey, while I've got money coming in, you're not likely to get your hands on it until next week, Tuesday. But you'll get it, right? That's a verbal guarantee, right? So when the feds are cutting interest rates, the rates that banks pay you to hold your money also tend to fall. And that's one of the things that we have to pay attention to, which is why I discourage putting money into banks. I strongly believe that if I'm going to hold money somewhere, I'm going to hold it into a high interest account of some sort. So stocks, bonds. I prefer dividend investments. And the reason why I prefer dividend investments is because if you put in the effort to buy and hold cash dividends, then the cash dividends are going to forever pay you money until you sell those stocks. And if you take the cash money from those stocks and forever reinvest it in something else, you will find yourself making a lot of money added to the money that you're adding to your portfolio. Where at some point during your life, you will see yourself getting that residual income coming in, where on certain days out of every month, all of your stocks are going to start paying you out. You're going to start seeing by the first of the following month, all of your money is sitting there waiting on you to collect it, and you can utilize that to advance pay on other bills. And that's one of the things I tell new investors is like, hey, a 100% cash dividend portfolio is fantastic to start up because you see the results every 30 days, which motivates you to do more. If you put away $1,000 and you get back 5% on that, that amount of money that you just got that month motivated you to put away another $1,000. Well, shit, if I put away that on $10,000, guess how much I'll have? If I put away that amount on $40,000, guess how much I'll have? If you're operating on a 20% return, that's when you really start feeling sweet because you put away $1,000 on a 20% return, you're looking at $200. And when you see that $200 coming back on that $1,000, where you know that the bank would have probably gave you a dollar or two, you're like, yes, I want more of this, and you start putting more down. And by putting more down, you start getting more back. And since you're reinvesting your interest along with the new principal, you're doubling down on your success rate, which increases and expedites your capabilities of reaching that $500,000 in 10 years, that whole million or 1.5 million in uh, 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 20 years. And that's one of the reasons why I talked to you guys about it. He said, Cat Williams' cousin, Nola, 504. Oh, special shout out to Louisiana. Louisiana born. What's going on, brother? I seen that 504. I was like, I know that neighborhood. I was out there. Them's these my stomping grounds. I appreciate you for dropping in. Algiers, special shout out to Algiers, West Wego, Freeport, Alexandria. All right. See, people, you never know who you're talking to when you drop in online. Make sure y'all like and subscribe as y'all come through now. So if banks are earning less on the money that they lend out, they are going to pay out less on the money that they take in, which is why I don't like putting my money in their hands. This is a few key places where you might have your cash parked. So, first, those high yield savings accounts. For the last couple of years, these have been a fantastic place for emergency funds, but those rates are variable rates. So just as your credit card APR will fall, the APY on your savings accounts is also going to start to um, tick downward. Banks might be a little slower to lower savings rates to stay competitive, but the downward trend is inevitable. So the same thing goes for money market accounts as well. The second area is the certificate of deposits or CDs. Here, you have a bit more control. If you already have the money locked into a CD, congratulations, you're not affected by what just happened. Your rates are fixed until that CD matures, which is why people do these CDs because they get in there at a fixed contractual rate. even if it's a escalating rate over the course of the contract. But if you're looking to open a new CD, the rates that you'll be offered will start to decline, which will cause you to rethink your position on whether or not you want to get a CD. This is going to create a strategic choice for you because if you have cash that you know you won't need for a year or two, now might be the time to consider locking in a CD rate before those CD rates fall even further. If you want that money coming back to you on a regular basis, it makes more sense for you to get stock options that have high interest yields on them, um, something above 15%. And typically, real estate investment trusts are some of the ones that have the higher rates between 16 and 22%. And if you're buying and holding on those and they're paying out the regular dividends, then you will see yourself making a lot more money off of your efforts. And that's one of the things that motivates you more to save. Because when you put money up in a CD, if you go buy gold or if you go buy Bitcoin, you don't have the money in between the time you invest it and the time that you get it back. Because with the CD, you have penalties if you close it out early. With Bitcoin and gold and other such stuff, you don't have any money until you sell, and you have to sell it for more than what you paid for it. Because if you don't have any money. See what I'm saying? But with dividends, as long as you hold that stock, whatever the interest rate is, that's how much they're going to pay you. So if they're offering you 5 cents a share for like Prospect Capital, PSEC, they're offering you 5 cents a share for a, as it stands right now, $2.46 per share stock option. That 5 cents a share would for 2,400 and that's like what 100 shares, 1,000 shares, you'd be getting about $500 a month off of that, right? And that would be every month, which means that you'd be getting about $6,000 a year off of $2,500. Where anywhere else, you're not getting that kind of money. Okay. So here's another key point for exiting fixed rate bonds that you already hold. The interest rate you earn doesn't change, but the market value of those bonds can raise slightly when the rates fall. Now, it's also important to know what the feds are thinking right now. Because during the press conference, Fed Chair Jerome Powell was cautious, and the discussion wasn't even unanimous. Three members of the committee voted against the quarter point cut, uh, showing a sharp division. The Fed's own projection only anticipates one more small rate cut for all of 2026. Now, what does that tell us? We might be entering a period of interest rate stability, just at a lower level. So for savers, this means that while the crazy high yields might be fading, rates are still much healthier than you were expecting them to be for the most of the last decade. So the key is to be proactive. Shop around for the best savings rates and consider using a CD to lock in your yields for medium term goals. Now, beyond the feds, the next big changes are coming straight from the IRS. Thanks to the new guidance on tax deductions that takes effect for the 2025 tax year, this is hot off the press information from our December 2025 year. This will take effect in your returns that you file in early 2026. These changes come from the tax reform known as the One Big Beautiful Bill, which created new federal income tax deductions for certain tips and qualified overtime. So let's break down what this means for you as employees. First, talking about the overtime deductions. The tax year 2025 through 2028, you can deduct the premium portion of qualified overtime pay. Think of it as extra half in time and a half pay required by the Fair Labor Standards Act, FLSA. The base pay for those hours still is taxed. So the regular hourly rate is still taxed, but that half hour that used to be taxed is no longer going to be taxed. So that premium is now deductible. The deductible is capped annually at $12,500 for single filers and $25,000 for joint filers. And it's targeted at low and middle income workers. So there's also a new deduction for tips. Um, if you work in an occupation that customarily and regularly receives cash tips, like restaurants, hospitality, or personal services, pole dancers, whatever, you know, you may be able to deduct up to $25,000 in qualified tips or income for the tax year between 25 and 28. So here's a critical part of your uh, tax year because 2025 is a transition year. And this means employers are not yet required to separately report new deductible amounts on your W 2 forms. IRS Notice 2025 62 gives employer penalty relief for the 2025 year. So you'll have to do the calculations yourself. I know that earlier this year we were talking about how the employers were expected to separate them, and you would have to look on your W 2 forms for that new section on your W 2 forms that shows where your overtime hours and your tips are non taxed versus all of the other income that is taxed. But this year, they're not obligated to show those results. So you're going to probably see a W 2 form that looks just like last year's W 2 form, and you have to personally account for the areas of tips that are not supposed to be taxed in the area of overtime hours that are not supposed to be taxed, which means you might have to go back and look at the last 52 weeks worth of check stubs. And I recommend that you go get them before the new year because you and I both know that rollover um, options with the company that it might not be as easily to download your check stubs from January, February, and March in the January, February, and March of 2026. So right now in 2025, you need to be going to your, if you don't have a copy of your check stubs, you need to contact your HR or contact your employer so that they can contact HR and say, hey, can I get another copy of all of my check stubs for this year? You know what I mean? And some of them are gonna bitch, but they should be able to figure it out because they've got to show you what your stubs look like as far as like what was overtime and what was not overtime, because you're going to have to separate this. Going forward, if you were not separating your overtime hours, you need to pull up some kind of spreadsheet and any claimed tips, you need to calculate those. And any overtime hours, you need to document those because when they make a mistake, that negatively impacts you. Okay. So, how are you going to calculate this? According to the IRS guidance, you'll have to use your pay stubs and payroll records, which is why I'm telling you to go get them. The IRS allows for practical shortcuts. For example, if your pay stub shows a single combined figure for time and a half overtime, you can treat 1/3 of that total as a deductible premium. So let's say that you're making $20 an hour and your job shows you that your time and a half is $30 an hour. Well, 1/3 of that is going to be $15, well, $10 an hour. So that $10 an hour is 1/3 of the $30 an hour, and that $10 an hour is going to be tax deduction. Now, when you think about this, remember I told you that you have $12,500 worth of overtime deductions. That halftime, if that halftime was $10 an hour, and you're doing uh overtime starts at like 40, and you're doing like 65 hours a week, then you're likely doing 25 hours of overtime, and that's an extra $10 times 25, which is $250 a week, which means that you're likely doing about $1,000 a month. And if you multiply that by 12 months, that's $12,000. Now, just thinking about that alone, you have the deduction of $12,500. So that's a pretty significant quantity at 25 hours of overtime a week, every week consistently for 12 months. It would effectively cover, if your overtime, if you're making less than $20 an hour, it'll cover 100% of your overtime hours. If you're making more than $20 an hour, then it's going to cover a majority of your overtime. See what I'm saying? Um, Michael's saying, special shout out to Michael. He said, keep overtime separate from your regular hourly wage. Well, see, people who have not been paying attention to that this year, they're going to start paying attention to that. But what you'll see on your check stubs is your regular hourly rate and then a separate line for your overtime hours. But it may not have a separate line where you have 40 hours of regular time, 40 hours or 25 hours of overtime at the regular hourly rate plus the separate line, the third line for the 25 hours of the halftime being deducted. Meaning, like if you get paid $20 an hour, you have $40 an hour at 40 hours, then you have $25 an hour for the 40-hour regular time, then a third line of $25 an hour for the halftime hour of $10 an hour, where that $10 an hour rate is deduction. See what I'm saying? That's the line item that they're exempt from having to provide for the 2025 tax year. Uh, but you yourself having the opportunity to be able to see that, well, I've done, 3,000 hours of overtime this year. One third of that is going to be deducted because it's the halftime that's being deducted, not the whole time and a half. So you're not. So a lot of people thought, oh, they're going to give us time and a half tax free. They're not. They're giving you the half for free. The time you still tax on. So if you work 65 hours, you've got 65 hours at $20 an hour. You're paying that. But the extra $10 an hour that they give you for the 25 hours of overtime, that part is deducted. So you got to pay attention to that part. So the and a half part. That's the part that you gotta pay attention to. Now, for tips, you'll need to rely on your own tip logs if you're taking any tip logs, or point of sale reports. And point of sale reports are going to be scenarios where cash tip scenarios are placed on a credit card, on a receipt. Um, Situations where the tips are typically logged in the company's system. Some restaurants require you mandatorily to report a minimum quantity of tippage, and anything above that minimum quantity of tippage, you don't have to report, but they expect you to report a minimum quantity of tippage. Based on those dynamics, you have uh, point of sale reports that figures out your deductions. So the takeaway is that for your 2025 taxes, there's a new opportunity to lower your tax bill if you have qualifying overtime or tip income. But the burden is going to be on you this year to do all the math. Oh, I love that. Special shout out to Mikey. Mikey says, how can I become a millionaire? Well, you don't become a millionaire overnight. There isn't an idea that can pop up into your head that is not a scam that can make you a millionaire overnight. There are legitimate ways that you can become a millionaire overnight, like winning the lottery, which is luck, um, investing in a high profit return, which is risk, starting up a business, which takes time, or robbing a bank. Now, if you're trying to become a millionaire the right way, it's going to take a long time, typically 10 to 20 years of investing in yourself, starting up something that's going to be long term. Mike says go to work. He ain't going to become a millionaire just by going to work. You have to go to work on a job that is going to pay you enough money to be a millionaire. They have to overshoot your living wage so that you have enough time or have enough money to save up. So to answer your question, Mike, in order for you to become a millionaire inside of 10 years, you would have to take 40,000 a year at least out of your income and put it into a 15 to 20% stock option that's paying cash dividends. And over 10 years, you'd have about a $500,000. And within 20 years, you'd have $1.5 million. If you date somebody that's got money, uh, if you date somebody that's got a job and the both of y'all put y'all money together where each of y'all is putting up 25,000 a year, because think about it, you're making like 50, 60,000 a year, your girlfriend's making like 50, 60,000 a year, y'all come together, y'all making like 120,000 a year, y'all living a 45 or 50,000 a year lifestyle. That's $60,000 or $70,000 that y'all don't use because your individual standards of living would be merged together. And if y'all were able to survive individually at 50,000 a year, y'all come together at 60,000 a year, y'all should be just fine. And if y'all got 120,000 a year income, you got like $70,000 there that y'all could be putting into a stock option. I can guarantee you that you would be rocking $1 million inside of 10 years if you're putting away 60,000 a year, because over the course of 10 years you'd have at least $600,000 plus interest. And if you're reinvesting the interest, you'd hit that mark. And 5 years after that, if you didn't make that $1 million at the 10-year mark, at 15-year mark, you'd definitely be well over a million. So that's one way to get in there. But you have to be diligent about your responsibilities. You can't just go in there and go and do uh like a get rich quick scheme. He says people say ownership trumps going to work. Yeah, depends on what you're owning. Because if you own real estate, first of all, real estate is work, pretty much, because you have to do a lot of research, find a lot of properties. You have to negotiate to the owners of those properties, pick up the contract for the property, then go acquire the money to get the property if you don't already have the money on hand. And that takes a lot more effort because you have to qualify for the money. And then after you do that, then you're supposed to go close the deal. Once you close the deal, then you've got to put people into the property. And once you put the people into the property, you have to deal with consistency in payments, where the first few months might be good, but every now and again you have a scenario where there's a hiccup, and that hiccup you have to compensate for. Um, and then you have to expand. And expanding means that once you get a good stability on this particular type of source of income, you would have to then leverage whatever equity you have left in the property and put that towards getting another property and doing it all over again. So while ownership will pay you more money for less effort over time, you're still putting in work. You're just building it from the ground up. You are the front line until you hire people to do the work for you. For example, you might pick up the first two or three properties, you might manage those on your own. You'll be making enough money to hire a management company. The management company will take over, you'll make less money, but you'll do no work towards the property. Then you'll have more time to focus on expanding and getting more properties. After a while, you'll get enough properties working under that same management company where you'll turn around and use that information, use that time and that income to go and hire people to go pick up properties for you. So now you're not picking up properties. Now all you're doing is closing deals. You're going to have enough money coming in over time to hire people to close deals. Now you're not closing deals anymore, and you're not picking up properties, and you're not managing properties. Now the shit's just expanding on its own. Over time, you can build something that is automated, as opposed to when you work for somebody, you only get paid for your presence, and you will only get paid a fixed amount for your presence until you beg them or negotiate with them to give you a raise. for your presence. If you don't show up, you don't get paid. Even though you might have a limited quantity of PTO time, a limited quantity of sick days, and a limited quantity of vacation days, the fact is that if you don't show up, you don't get paid. So the best way to go so that you don't have to work anymore is to invest in something that's going to pay you so that even when you don't do anything, so that you're continuously getting money. And then the money that you don't need, you reinvest it in that to increase the quantity of money that you're getting paid so that when you do stop working and you need the money, you have more money coming to you than what you need. And that is a benefit because then you'll be able to take what you don't need, reinvest it to increase your principal, and then take what you do need and live the life that you want to have without having to stress about where the money is coming from. He said, faster that way, right? Yeah, it is faster to invest. Um, Michael says, properties auctioned off for pennies, buy them. No. Okay, so when he puts this up there, bid for assets thing, it's not necessarily because you're auctioning off to the highest bidder, which means that you're not necessarily going to get these properties for pennies. The fact is that you have to do your own research, and you're going to be looking for places that nobody wants or nobody knows exist. You're going to be going into places that have a high supply of real estate and a low demand for it. You're going to be picking those properties up dirt cheap because nobody knows they exist. Then, instead of trying to flip them and sell them back out, you'll be able to hold them and use them as rental properties. After you put the rental property up, or put the tenant up in the rental property where that property is generating revenue, then you can leverage it. So like he's saying here that they got some properties in there that go for 40,000 and resell for a value of 422,000. The fact is that you're going to get that property at 40,000. You're going to hold that property at 40,000, put a tenant in that property, but because that property is generating revenue, it's not just worth 422,000, it's worth 422,000 plus the rent. So now you could potentially leverage that property instead of selling it for 422,000, you could leverage that property for 300,000 and use that to go buy what uh six more properties at 40,000 a piece and put the rest of it in your pocket as payment, advance payment, and then you don't have to worry about where your money's coming from for your bills because while you're expanding in the company, you already paid yourself first. And that's one of the biggest rules in real estate is always pay yourself first because if you pay yourself out of whatever's left, you're not guaranteed to get anything. If you pay yourself first and then start spending money on everything else, everybody else is going to get whatever's left after you get paid and your standard of living is secured. Yeah, and then those apartments pay for themselves and become cash cows because you're holding them. Uh, yeah, and I do not like servitude either. He said going to work is servitude. Yuck. You're smart. Own the company and let's go fishing. That's true. Question: have you checked the site out? I don't know how that makes a difference, Mike, because however many times that I check out the auction sites and however many times I check out the real estate investment sites, the deeds, tax liens and deed lien sites, uh, doesn't change the fact that the dynamic is still the same. When you're auctioning off to the highest bidder, you're either going to find about the properties that have the least amount of value, or you're going to, well, not the least amount of value, the least amount of interest from other people, or you're going to be going up against prime properties with people that have deeper pockets than you. Okay, because we're not talking about one company versus another. We're talking about an individual versus a real estate investment firm. Okay, so from a person to person recommendation, because yeah, I understand that you do a good job of going through estate sales, but if you were trying to auction or bid in an auction with dealers where they wanted the item that you're trying to get, in order for you to outbid them, you would have to have deeper pockets. You go places where estate sales the people who are there don't really know the value of the stuff that you're looking at. You'll get it, somebody else will want it, and then you'll sell it to the other person. But that does not change the fact that if you were sitting next to somebody who had the same knowledge that you do with three times more money than you do, that you would have a harder time getting that exact same item. And that's what I'm talking about. Is that most people will never read a book if given to them. Well, of course, most people don't pay attention to the information that's online, which is the reason why my podcast exists, is because I'm taking common knowledge that could have been publicly researched if people actually gave a shit about improving themselves. And I put it into a video where they now listen to the video. And after they listen to this video, they go and do the research and verify what I told them, and then they take action on that. So most people don't like to read. That's one of the reasons why YouTube is so popular, because every how to video about every book that has ever come out has been made because people don't like to read. That's the same dynamic as I go to car auctions and get cars even when dealers are there. But you're going to car auctions getting cars that dealers aren't interested in, which is exactly what I said before, is go pick up a property that either people don't know about or nobody is interested in, because the one that nobody wants is the one that's the cheapest one to get. You're not telling me that you're going to go to a car auction and outbid a dealer for a 2024 Chevy Malibu. You know what I mean? You're going to go to an auction, you're going to find a car at a good deal because that car has a reasonable quantity of mileage. It's going to have a reasonable body style. You don't plan on doing any repairs on it. So you're going to pick up a certain type of car and then you're going to put it out. But think about this though, dealers are more often than not going to try to pick up a car in the last 10 years. Auctions can have cars that are 20 years ago. You can pick up a car that is 15 years ago in really good condition or really decent miles that most dealers might not want, and you could then put that car out there for sale. Somebody will buy it because of the price, where your standard for quality vehicle is not the same expectations of a dealership, where you're going to go and get something that they're not looking at. So just because you're sitting in the same room as somebody that's got deeper pockets than you doesn't change the dynamic of my argument. Is that at the end of the day, if they were looking at the same item you were looking at and they've got deeper pockets, they would outbid you, which is why you're going after things that other people aren't paying attention to. So, still not disproving my point. If they have nothing invested in it, well, yeah, if the dealership doesn't have nothing invested in it, you want to go with me? No. Well, okay, look here. Point proven. I'll buy a 1974 truck from an auction. Exactly. But most dealerships probably would not go out there and grab nothing less than a 2015. Likely. Used car dealerships right now, buy here, pay here's, might have a 2010 on their lot. You're buying a 1974. 1974 truck is going to be valued by antique dealers and collectors. So, depending on the condition of the truck and whether or not they want to invest the money to restore that truck, is going to determine whether or not they get that truck. But you buying a 1974 truck for 500 bucks at the auction is not the same as a dealer putting down $15,000 on a Porsche from 94, or ironically a Porsche from 2001, or not 2001, 2006, 2008, 2010, stuff like that. Did your school have a debate team? Uh, I don't think that makes a difference. My college had a debate team, but I wasn't on the debate team. I was on the student government. I actually spend most of my time debating in the legal system since, laws aren't made for people with good tans and we have to fight for ourselves because nobody else will. But I don't think that that's the dynamic here. The fact is that true to life, as I made the statement, no, you you say blue, I say red. No, what happens is that I made a point, and you tried to undermine the point by coming out of the out of left field with something with a straw man scenario, as if the dynamic is different, and the dynamic is not different. I said from the gate, going to an auction is selling to the highest bidder. That's what I said. And I said that from that dynamic, you don't want to go against a highest bidder scenario as an individual. I said that you would want to go do your own research and find properties that no one else is interested in so that you can get those at a cheaper rate. Put a tenant in there, and because that property you could pick it up at $40,000, then you would put that property, put a tenant in there, and then leverage that property for 300 grand. Because if it can be sold for 450, you can get 300 grand for it. Put 50 grand in your pocket, and then buy five more properties or six more properties doing the same method, where you're getting undervalued properties because nobody's interested in them, and then you can utilize that to expand your business. Then you argued about whether or not I've been to the site, which has nothing to do with what I said. And then you started talking about how you're capable of doing this with uh, your estate sales. And I reminded you that if you were in the same room in an auction scenario with somebody with deeper pockets than you and they wanted what you were looking at, they would outbid you. Then you made it seem like you're a pro and outbidding car dealers. And then we went down the rabbit hole of uh, what type of cars a dealership might get versus what you would get. And again, as soon as I made that statement, you came back and reinforced the fact that you would get a truck from 1972. And I'm explaining to you that dealerships would potentially get a vehicle within the last 10 years. We're in 2025, 2026. They would likely get a vehicle in 2015, 2016. So while you would be in the same room as a car dealer, you're bidding on a 74, they're bidding on a 2025 or a 2015. Y'all aren't interested in the same item, which reinforces what I said at the beginning. And then you're telling me about the apples and oranges discussion. The fact is, we say, well, I should be on the debate team. Well, you should pay attention to my statement, because when I said that if they're going to go to an auction, that's not a good idea unless they're going after something nobody else at the auction wants. Because you, as an individual, going to an auction with companies, they have deeper pockets and they will outbid you, or you'll get it from them over the amount of money that you want to have. He said, no, you love to argue the point. No, I like to prove the facts. And when you make a statement that is irrelevant to the facts to try to devalue the facts, I remind you of the facts so that you can be clear as to the fact that the situation hasn't changed, regardless of how you put the information out. It is still the same. You must bid on something other people don't want in order for you to get it at a cheaper rate. So if someone wants a car that bad, then let them have it. Many cars at the auction. So now you're deflecting. Exactly. Yeah, you are old. Yes, you are old. A 1974 vehicle. You're 71, going on 72. So of course you're old. But a 1971 vehicle, 1974 vehicle, is not the apple of the eye of the average certified pre-owned vehicle dealership or the average eye of the used car dealership. The buy now, buy here, pay here place. They're getting something that typically has a monetary value of around $5,000 to $10,000. They usually try to keep it in that cash up front situation. And at the end of the day, once they get it to that point, Yes, yes, I see how communication works. Yes, that's why you address each one of your communications individually. But once they reach that point where you start getting over $10,000, they're guaranteeing that their buy here, pay here customers are going to have to get a loan on the vehicle. If they want them to buy here, pay here, they're going to stay inside of a certain range. It's going to be a little bit above $5,000 unless they're willing to pay cash up front. They might pay 4,000, which means that the person probably bought it from the dealership between 1 to 2,000 so that they can get a 200% return. And if they finance it, they're going to finance it at 6,000, or they're going to go as high as 10,000. And a 1974 is not going to be sold at an auction for 2,000. A 1974 might be sold at an auction for 200 or 300. In 2026, maybe a 2005 might be sold at 750. And based on that dynamic, you're not looking at the vehicles that everybody else is looking at, and whatever value you find in those items, that's different from what the deep pockets are looking at, which still validates my point that in order for you to turn a profit, you have to look where everybody else is not looking so that you can find the deals. The whole idea and definition, even in stocks, even in investments, the whole idea in finding undervalued items. Undervalued means that it has more money or has more value than what it's priced at because nobody's looking at it. So you can get it cheaper than what you should have gotten it because nobody's looking at it. That's the idea. And if you get it and then everybody else sees it and then they go dive onto it, that increases your profit margin because you got it on a wholesale position. No, it may go for 30,000. You say that, but that's not necessarily the case. You're you're okay, so your 1974 could be sold for $30,000 depending on what condition it's in. But again, you're not putting $30,000 on a 1974 truck so that you can sell it for $40,000 because the speed at which that vehicle is going to get sold might not be for your taste. Yeah, I drive past Camaros and Chevelles right now that's on my block that's been sitting there 15 years for sale. Whoever bought that car and restored it, hey, they got some 69 Impalas on my block. And at the end of the day, it does not change the fact that they're not selling as fast as you think. This isn't an instant turnover scenario. It's like holding a Mona Lisa. You say, oh, check out the classic trucks and cars. I check out classic trucks and cars all the time. But that doesn't mean that that classic truck or car changes ownership every day. It might be bought this year, held by its owner for 10 years, and then sold 2 years later. The vehicles you pick up a $40,000, 30-year-old truck, 50-year-old truck, that truck ain't being sold that quickly. Like I said, it's like auctioning off, not even auctioning off. It's like selling a Mona Lisa. It's like selling a Picasso. It's like selling a Fabergé egg. It's like trying to get stock market value off of a brick of gold at a pawn shop. It's hard to do because an item is only worth what someone else is willing to pay for it, and you have to find the person that was willing to pay what you want for it in order for you to get rid of it. Yeah, two-door SSs that are sitting on the block right now, like four of them. Been there. Matter of fact, first time I seen them put on that lot was about 10 years ago, and they're still there. I drive by them every day. Think to myself, half of me wants to buy it, and the other half of me is like, nah, that motherfucker probably got some maintenance work that need that, and the parts are discontinued. So if it needs some work, I can't afford to fix it. They still sit there. They got Mercedes Benz down the street from that are like 1965, 1970. There's a whole antique lot. There's a whole neighborhood full of antique cars for sale that's been sitting there collecting dust. A used car dealership that's trying to buy a car today that's going to be sold by the end of the month is not buying that vehicle. So again, that reinforces my expectations to the magnitude that it it you're looking into something that they're not interested in. I said dealership. I didn't say someone's yard. So if you put it in someone's yard, it's even harder to find. So that still reinforces the dynamic. So let's get back to these policy changes. No, you and your two hands will fix them. I'm not fixing shit. This is the difference between a boss mentality and a worker mentality. As a hobby, you can fix your own cars. As a business, because what we're talking about here is building money. We're talking about taxation, and we went down a different rabbit hole to entertain your straw man topic. But uh, in the mentality of a millionaire mindset is that we're not trying to put ourselves in situations where we're using our own manual labor to get stuff done. We're trying to automate life. You get started, you set things up, it runs itself as you move somewhere else to uh, build something else up. That's the point of automating life. If you're not automating life, you are doing everything yourself and you run out of time in a day. You run out of time in a year. You run out of free time. You run out of time with your family. You run out of time with your friends. You run out of time in your own life. And then you end up looking up one day and recognizing that I haven't done shit because you spend all of this time doing it all yourself. I spend less time doing all of this extra stuff and more time automating things so that other things can get done by other people and other entities so that I don't have to do all the work. We make AI for that exact purpose. You say you work too much. No, actually, I work far less than most people. I can definitely show you, I can tell you right now that I'm not clocking in on 65 hours of work, but I can tell you that the split schedule that I have negatively impacts my sleep schedule, but I also dedicate myself to this podcast in addition to everything else that I do. But I got myself involved in like four businesses right now. So the fact that I can get myself involved in four businesses right now and still have the capabilities of having dedicated time off. Actually, I don't work as much as other people, but I actually still work more than what I would prefer because I would prefer my automation to be set in a fashion where I would have more money coming in and less effort going out. But that requires me to put more time into automating more things. So I'm not fixing a vehicle myself. I got three cars outside right now that I know that if I want them fixed, I will bring them to a mechanic or bring the mechanic to the vehicle. That's it. That's it. I'm not putting in no effort nowhere. Put the people to work, then give you some then you give it to someone else to manage it. That's the millionaire mindset. Then why are you falling asleep? I'm falling asleep because again, split schedules. So I have a schedule that's from 3 to 6. I deal with the show. I have the show from 10 to 2, 3 o'clock in the morning, so give or take. Sometimes I stop early. Then I have a schedule from 1 to 9. And then I have to deal with medical appointments with family and other such things that are from 9 till like 3. And then I have to go back to work again. That's why I fall asleep. If I wasn't taking care of other people when I should be in bed resting, I would be asleep. I would be rested. Then I wouldn't be falling asleep. If I wasn't doing this podcast, I would have plenty of time to sleep. If the podcast was the only thing I was doing, I would have plenty of time to sleep. But how much time am I actually on the podcast? How much time am I behind the scenes on a podcast? About 5 hours out of the day. But the split schedule, yes, you do need a job. You do need a job because once you get back to work, then you'll be able to understand the dynamic. I'll let you get back to your topic. I'm glad I took typing in high school. Well, I typically try to. I don't mind sidestepping on the topic because I'm at right now 33 out of 49 pages, so I don't got that much left. I got about 16 pages left, so I have plenty of time to side topic it because guess what? I started the show on time, so I started at 10 o'clock Central Standard Time, which allows me right now at 11 hour and 27 minutes, so another 20 more minutes worth of the main topic. I had no problem with sidestepping to a different topic because I don't have anything else to do because my next client is at 6 a.m. So I've got about 5 more hours before the next client that I have. So I could technically take my dog for a walk, go take me a nap, wake up, go take care of this client. You know what I mean? That's why I tell you because it automates these things. Is then the only reason why I took typing is so that I can write down what my mind is thinking or saying. Pretty cool. Right. Cool with a C. Uh, I took typing because they had typewriters in the classroom. Then they put computers where typewriters used to be. And the keyboard doesn't look like a typewriter, but the dynamic is still somewhat the same. So I'm able to get in there and knock it out. But the research that I have, and that's the only reason why I jumped into that side topic is because the research that I have leads to the logic that I have, and the logic that I have is backed by facts. And when you make a statement that's illogical, I mean, yes, you have your own method, and your method is effective. This person came and asked about making himself financially successful, and you're saying, "Hey, run to this auction and go take a look because you might be able to find what you need." It is true. No, Kool Aid is Kool with a K. Cool is Cool. And if you spell it with a K, that doesn't make you cool. That makes you illiterate from an educational standpoint. Now, from the Urban Dictionary, cool with the K uh, uh, makes you, dapper. But from an educational standpoint, you misspelled the word. Nevertheless, when they come in and they ask a question about how to make themselves more successful, I just got to let them know what the dynamic is. So, you weren't wrong with what you were saying. It's just, it didn't deviate from what I was trying to present there. I think that's the whole observation is that while yes, they can go to the auction and pick something up, if you're going there with the money in your own pocket, you're not backed by millions, you're not backed by hundreds of thousands of dollars. You're trying to go and grab something for 10, 20, $30,000. You're likely going to do better going places where less people are looking at the stuff that you're looking at. And that means that you're probably going to get the leftovers from the auction, uh, or you're going to the auction specifically to go get something that nobody else is looking at. He said, off the plate, remember to like and subscribe. Well, good luck with that. Hopefully you win. Uh, so back to it because we only got like 16 pages left. So we don't have, I probably 10, 20 minutes left of tonight's topic. It's important to understand uh, what the recent policy moves don't do for your income or taxation or the other areas of investments. Because not every change puts cash directly into your pocket this week. For example, recent IRS and Treasury guidances has largely focused on business facing rules. So on December 19th, the IRS issued a Notice 2016-01 creating a safe harbor for businesses claiming the SEC 45Q tax credit for carbon capture. See, that's why I was telling you, Michael, there wasn't a lot of stuff to talk about as far as the individual people because I'm about to get into big business stuff. This mainly affects project investors and energy companies, not ordinary wage owners, though it could influence energy prices down the road. Similarly, the administration has announced new economic policies aimed at boosting domestic manufacturing through infrastructure investments and tax incentives for firm producing in the United States. So this kind of initiative can affect jobs, wages, and prices over the long term, but they do not immediately change individual income tax rates or put cash in your pocket today. So the most noticeable effects for you in the coming weeks is likely to be that slow adjustment in loan and credit card rates, not a sudden change in your paycheck. So that means that your check is still going to be your check. The money's still going to come out of your check. But the difference is that when you file your return, you're likely to see more money coming back this year. So the new tax rules are for when you file the 2025 tax season between January and April of 2026. It is not a stimulus that changes your cash flow today. Okay. So while those tax deductions are for the 2025 year, an even bigger set of changes is set to revolutionize how we save for retirement in 2026, thanks to the Secure 2.0 Act. So let's start with the new contribution limits for 2026. The maximum that you can contribute to your 401k, 403b, or thrift savings plan is increasing to $24,500. The limit for IRA contributions is also getting a boost to $7,500. For those 50 and older, the regular catch up contribution is increased to $8,000 for 2026. This means if you're 50 or older, you can put a total of $32,000 into your 401k next year. But here's where a major new rule for Secure 2.0 kicks in for the first time. Starting January 1st, 2026 and after, if your wages in the prior year, 2025, were more than a certain threshold, currently projected at around $150,000, any and all catch-up contributions you make must go into a Roth 401 account. You will no longer have the option to make those catch-up contributions on a pre-tax basis. So this is a huge policy shift designed to get more tax revenue to the government today. But wait, it gets even better. For some savers, Secure 2.0 also introduces a super catch up. Now, this is specifically for people who are ages 60, 61, 62, or 63. Because for 2026, this special catch up amount is a whopping $11,250. So if you fall into that 4-year age window, your total 401k contribution limit for 2026 is an incredible $35,750, which is the $24,500 regular contribution and the $11,250 super catch up contribution. So this is a golden opportunity to turbocharge your savings right before retirement. And remember, if your income is over that high earner threshold, that entire $11,250 super catch up must be made on a Roth basis. So we've covered a ton of ground today from the Fed's rate cuts to the 2025 tax deductions and huge changes coming to the retirement savings in 2026. We also spent a decent quantity of time talking about investments in stocks and bonds and real estate and car dealerships and antique cars and auctions. So if you found the breakdowns valuable and you want to make sure that you never miss a critical update that affects your wallet, do yourself a favor right now and make sure that you take the time to hit that subscription button and turn on the notification buttons because we are constantly tracking these developments to give you guys the information that you need to know what to do when you are trying to improve your wages. He says, what apologies? What was the rate for 49 and 50? Um, I don't think you understand the dynamic. So you said from 40 to 49 is going to be the regular rate. There isn't a catch up rate for 40 to 49. There's a catch up rate for those 50 and older. Yeah, the reg. So let me go back over for you one more time, uh, so that you can see what's going on. Uh, you have the 401k and 403b or thrift savings plans increasing to $24,500 for everybody that's under the age of 50. The limit for Roth IRA contributions is also getting a boost of $7,500. That's for everybody that's under 50. Now, for those 50 and older, the regular catch-up contribution is increasing to $8,000 for 2026, and that means that you would go from the $24,500 to $32,500 if you're over the age of 50. Then they're giving you an even bigger uh, scenario because they're maxing anybody making over $150,000 must put the money in their Roth IRA. They cannot decide where to put their money. If you're making less than $150,000, you can put it in your 403b or your thrift account. But if you're making over that, you can't do it. Now, the other thing is that 60, 61, 62, and 63 have that $11,250, which is a little bit more than the $8,000 for the same 401k, which will bring your original 24,500 for everybody under 50 to 35,750 for people between 60 and 64. And that's going to give you guys the ability as you're on the closest levels of getting hitting that wall of retirement that you can put in as much as you can right before you retirement. No, I don't mind. We start the show about an hour and 40 minutes ago, and here's the thing, um, because all of the live podcasts that I put up stay up. If you want to get any information, you can always go back and rewatch the show because all of the shows are available on Twitch, Twitter. Well, they're available on Twitch uh, for the most part, but Twitter has a longer database and YouTube has a longer database. And you can just go back to this show and move back and forth across all the information that we had so that you could get a lot of this information. So even though you came in late, there's never a problem where all of the stuff that we talk about, like for today's taxation, other stuff that we talked about for taxation earlier this year, any changes that we had discussed about interest rates is up there, investment opportunities, stocks and bonds that we were talking about, ways to get uh, a new source of income, digital nomad capabilities, um, investments around the world, changes in your negotiation skills. Anything that we've put up actually since as far back as I want to say August of last year is still up, and I don't plan on taking anything down. So you can go and get any type of investment information that I put up over the past like 15 months. And any information that I've given you about personal development, and you can put all that stuff together because I have trusts, um, LLCs, C corporations, offshore banking, passports, dual citizenships, uh, unorthodox investment opportunities, because it's not just real estate is the most common one to get. It's the easiest one to get into. It's the hardest one to get into because you got to have money or you got to have stuff, but you can do it anywhere because every country around the world needs development in housing. But I give you guys unorthodox ways to make money. Preferably trying to find ways for you guys to make money for yourselves by putting up a little bit of money and getting back money without having to do anything other than finding other places to put your money. So if you've got money that you don't mind losing, you can put that money in places like, for example, investing in legal action. Anybody that's running a lawsuit, if you pay the cost of the lawsuit under a contract where you get a certain quantity of money back off of the settlement of the lawsuit, if they win or if they settle, you get a percentage off the top of the settlement, and then they do whatever they want with whatever's left. Um, I've noticed that for car crashes, you have people that are getting into that business where they're partnering with law firms and offering that basically gap funding for individuals who need subsidized income in between the crash and the settlement. They encourage you to typically only go towards 20% of the available amount of money that could be settled upon. But again, for every $5,000 that you offer up, if you're getting back $1,000 back as a profit, you go into a civil case where they might get 30 grand and you put up 10 grand, you're getting 12 grand back, and that's going to be a 6 month settlement. Odds are, usually, you do that quite a few times, you can start getting back a significant quantity of money back on a regular basis. So these are the opportunities that we talk about, which is why I tell you guys to make sure that you like and subscribe because there's a ton of information that I go over. And that's why me and Michael was going over a lot of stuff today about estate sales. We are going over investments in real estate platforms. We were going over opportunities to tax liens, tax deeds. And actually, one of the things that I wanted to talk about tomorrow was the different type of ways that you can acquire a property deed or get rid of a property deed. Since I know that Crank It Up is going to come in and start talking about real estate stuff tomorrow while we're talking about the dividend rotation strategy. And we could navigate different ways to make money for ourselves. Because, like I was explaining to Michael, it's the worker mentality, or if you want to do it as a hobby, yeah, you can fix stuff yourself. But the worker mentality is to get in there and get your hands dirty. There's pride from back in the day. This is generational pride from accomplishing getting stuff done on your own, right? But the millionaire mindset is not about getting everything done by yourself. A self proclaimed self made man is not self made. A self proclaimed self made man is a man that had been offered an opportunity by other people around them. And that person took advantage of that opportunity to the fullest and was able to make themselves successful. But the opportunity was offered. They did not carry you the whole way. They showed you where money could be made, and you went and made as much money as possible. That's a self made man. They might have, like, for example, a self made man in politics might be somebody who got an intern position in a government office and ended up in Congress. Not because every time he moved up, somebody offered him a new seat, but because that first person that offered him an in the general politics, he used that to get the experience that he needed to carry himself everywhere else he wanted to go. So it's not about doing it yourself. It's about getting it started yourself and then getting help along the way, which is why I talk to you guys about improving your network as well as being a benefit to your network. If you are getting help along the way and helping people along the way where you're able to improve yourself and improve your network as you get better, you will find yourself in a position where you have people doing stuff for you. So, yeah, 20 years ago, I'd be working on my own car. Now I'm paying somebody else to do it because I got better things to do. 20 years ago, I'd be fixing my own house. Now I'm paying somebody else to do because I got better things to do. 20 years ago, I would be managing 15 properties on my own, driving around, trying to fix stuff. And Now I will hire a management company to manage those 15 properties so that I don't have to do it because I got better things to do. Okay. How you determine when you're capable of walking away from it and putting somebody else in place is determining how much profit you have to give to the other entity for them to take over that responsibility for you. Because you're not going to be able to make 100% of the same profits. Because out of 100% of the profits, if you got to give somebody 20% of the profits so that you don't have to work, you've got 80% now, but you don't have to do any work. Every level of business reduces the profits. As you expand on the business, you're increasing the revenue. So at some point, you might go from being directly involved in the day-to-day operations to being 5 levels removed from the day-to-day operations and now only make 10% out of the business. But if the business is making $1 million and you're making 10% out of the business to do nothing, then you're getting 100 grand. If you're still getting 50% out of the business and you kind of got to show up and do some stuff some days, but if the business is making $500,000, you're still making $250,000. So when you decide where do you want to stop with this bit, first you want the business to be able to run itself. Because if you're future thinking, you're not going to be physically capable of continuing to do the manual labor that you always do. Okay. Even me myself, y'all see me half asleep on a podcast sometimes because I don't always have the energy to do nighttime work and daytime living at the same time. So eventually, I'm going to either have to cut out my daytime or cut out my nighttime. I dedicated myself to the podcast, so this is something that I'm going to be doing over the next 20 years. So that means whatever I've changed in my life is going to give me the ability to put more effort into my podcast, right? So that means I have to automate making money elsewhere so that my end goal can be sitting in this chair. Once you set the goals for yourself, that's when you're able to figure out how to not navigate. That's how you're able to navigate where you're going to go in the future. Okay. So the financial world can feel like there are powerful forces in Washington and at the Federal Reserve that are moving pieces on the board that you can't even see. And I understand that a lot of this stuff gets confusing, but it doesn't have to feel that way, right? Even when it looked confusing for Alter Ego, special shout out to Alter Ego. The point of tonight's show is to show you that these changes aren't just abstract headlines. A quarter point rate cut is a real change in your credit card payments. A new tax rule is real money you don't have to pay on taxes as long as you know how to claim it. And that Secure 2.0 Act that he asked about isn't just legal jargon, it's a chance to put extra thousands or even an extra $11,250 into your retirement account next year. Knowledge doesn't just give you power, because I know everybody says knowledge is power. Knowledge gives you agency because it turns you from a bystander into an active participant in your own financial story. Because when you just go to work whenever they tell you to, always on call because you need more money, never having a day off, never having any fun, always tired, but you barely make enough to get by, never because your job isn't secure. It's considered a secure job. And the reason why it's considered a secure job is because you've been on it for a long period of time. So the hypothesis is that if you've held this job for 10 years, you're not likely to lose it in the next 10 years. But the truth is that if you held this job for 10 years, you can get fired tomorrow. Since your future isn't guaranteed, the dedication that you put on the job does not hold merit towards the termination that you're going to end up getting. Eventually, you're going to be too old for this. Eventually, your motivation is going to die down. Eventually, your work ethic is going to die down. And when you are no longer useful to the company, you will be replaced. Eventually, you're going to cost more than your performance. And they're going to replace you with AI if they don't replace you with a younger individual that's willing to take less and do more. And at the end of the day, in America, right to work state, they don't have to keep you employed. They can fire you for absolutely no reason and give you the W-2, not the W-2, the workman's compensation or unemployed compensation for the 12 months, and that's it. They can bite that bullet, but you don't have enough money. If you was living off of 100% of your overtime hours, and now you're starting to get 60% of your average pay, you're 40% short on the amount of money that you need to survive. So even though you can get fired off your job and get on work unemployment compensation, you still need to find you another job to cover the other 40%. But if you find ways to make money for you, and you find ways to put your money in different places so that you have extra money to fall back on, so that when you quit or get fired, you've got enough money to survive. You know, that's when you start getting better. Because the one stressor I don't have in life is wondering how my bills are going to get paid for January, because I already paid my bills for January at the beginning of December. You know what I mean? I don't have to worry about where my money is coming from because it gets direct deposited every month. I can use my fintech, special shout out to Fintech 101. I can use my financial technology to track where my money is and where it's going, send it to where I want it to be at. And the fact is that when we start paying closer attention to what we need and how we need to get there, we can put more effort into making ourselves more successful. You'll find that if you've got more money to spend instead of wasting it, you've got more money to invest. Plenty of times there are things that I think about that I wish I could go and buy, that I want to go and buy, that I have the money to go and buy, but I don't buy it. Why? Because I think to myself, well, I could have that, which would ultimately collect dust, or, or, or I could put that money somewhere else where I could start making more money to go get that later out of the profits, where I'd still have it. But the difference is, instead of me putting my principal on it and then having to go make more money, I can put my principal on something and use the interest to go get the luxuries in life. One simple shift in mindset, you go from wasteful spending to high end investing. I'm not saying don't live a life of fun. Yeah, you should be able to entertain yourself. You should be able to get your vacation in and stuff to that effect, but within reason. You should be able to find a way in your life to take something 20, 30%, 40%, put it away. And if you have entertainment after that, that's fine. But you know how you do that? First, you're cutting off stuff you don't use. That's how you do it. That's the first thing you do. You cut off stuff that you don't use. You turn off all the memberships that you don't need. You if you've got a whole bunch of vehicles that you're not using, you get rid of some of them. You or at least take the registration off of them so that you don't got to pay the insurance on them, so that you can save money on the insurance. If they just sitting in the yard, let them sit in the yard, but don't pay for $300 a month per vehicle for 5 vehicles that's not being driven. Save you some money somewhere. The fact is that if you can reallocate your funds in a more effective way, everything that you want to do in life will still get done inside of your budget, and you will still have extra money left over. And the extra money that you have left over can be invested. If your goal is to put away a certain quantity of money, you can put that money away first while making sure that the base quantity of standard of living is covered. And then if you've got any money left over out of that pie, when you broke it into three pieces, your guaranteed investment opportunity outside of your guaranteed financial responsibility, that other third can be utilized for entertainment. Whether you want to buy frivolous things or if you want to go and enjoy the life of Riley. But like I said, 40 grand a year put aside. And I can calculate it. I can calculate it, uh personal habits can cost you almost $1,500 a month per habit. And then dating could cost you another $1,500 a month. And that could lead to $45,000 a year between two different daily habits and dating. At least as men, could cost you upward of 45,000 a year. Cutting out unnecessary habits and not wasting money on unnecessary engagements that are ultimately going to leave you frustrated in the first place. That 45,000 a year, you can put that into high interest savings between 15 and 20% and make yourself a millionaire inside of 10 years. At least 15, if not 20, taking into consideration the opportunities where you might have an emergency somewhere. And the fact is that knowing that a 20-year plan, you could change the way you spend your money. And even at 40 years old, by the time you turn 65, you won't need to work no more for the rest of your life. Even at 30, 55, you wouldn't have to work no more. Even at 20, 45, you wouldn't have to work no more. You would if you wanted to, but you don't need to. You would be able to take what you do and you would be able to go where you need to go and live the life that you want to live, and you would be able to upgrade your standard of living. So if you was operating off of 30% of your standard of living when you had to work for it, think about how much you got going on when you don't got to work no more and you're making three times more money than what you was making before. You now know about the opportunities and the new rules presented by these quiet policy changes, and you guys can find out everything that you need to know to make certain changes in your life. You have the blueprint. Your job is to take action. You have to review the debts, everything that you got going on. You need to gather your 2025 pay stubs to prepare for the new tax deductions. And you've got to plan your contributions to take full advantage of the new retirement limits. Don't just let the information that I'm giving to you guys be interesting to think about. Let it be profitable. Let it be the catalyst that helps you build a stronger, more secure financial future. You guys have to stay informed and stay proactive. I want to thank you guys for coming to tonight's show. But before we go, I want to say, ladies, as long as the situation doesn't make sense, I'm going to keep asking you ladies to make it make sense. So, ladies, please make it make sense. Fellas, I give you guys this information to help y'all become higher value men so that you can take this information and change the things in your life that you can control and then navigate around the things that you cannot. Ladies, while this is a male driven podcast from the male's perspective, you too can take this information and make yourselves higher value women. You just have to readdress how you prioritize the things in your life. Now, one more time, I want to thank you guys for coming. Tomorrow, we're going to be talking about the dividend rotation strategy and potentially different ways to acquire or get rid of a deed for a property. So we're going to be talking about that. So I want you guys to stay tuned for that. So one more time, thank you for coming to This and That. I'm your host, Xander, where we talk about this, that, and everything in between. And I'll see you guys tomorrow night.
That's my personal command. I'm not mounted on higher ground where excellence is found. My potential knows no bounds, raising the bar, breaking ground. I'm not just living, I'm manifesting my vision, cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield to mediocrity and chaos. I will never I'm not just living, I'm manifesting my vision, cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield to mediocrity and chaos. I will never yield.